Welcome back to the deep dive, where we tear through the stack of corporate documents, financial statements, analyst presentations, the earnings calls, and really try to pull out the essential intelligence for you. Today, we're diving deep into the Indian Hotels Company Limited, IHCL. We're looking at their Q2 and H1 results for the fiscal year 2025-26. And, I mean, you have to start with the headline, right? It's pretty staggering. IHCL just clocked its 14th consecutive quarter of record financial performance.
14 quarters, unprecedented, really, especially in the hospitality space,
Yeah.
with that kind of momentum.
Exactly. So we've gathered all the available materials to figure out, not just how they hit those numbers, but how they're sustaining this resilience.
And what's fascinating is we look through these sources, the mission here isn't just a pat on the back. It's really an analytical investigation. We need to dissect the mechanism behind this sustained growth, specifically their whole expanding footprint, deepening impact strategy, and understand how they're positioning the business for, well, long-term dominance, especially because management was quite open about navigating some, real short-term market turbulence this quarter.
Okay, let's unpack that resilience then, starting with the ultimate validation. The half-year figures, H1 FY26, these are the consolidated numbers. Revenue climbed to 4,226 crores. That's a 21% jump year on year.
21%.
And Sonia?
Telling you 10. And this is PISA.
No.
And it's ispia telling you one of these score bands.
It really does. And the profitability seems to have followed suit.
It did, yeah. H1 EBITDA saw a similar climb, up 22%, hitting 2,291 crores. But here's a detail that caught my eye. The profit after tax, PA, came in at 581 crores. Now, that's a strong 17% increase, even when you strip out a pretty significant one-off exceptional gain they had in the prior year. So it looks like clean, repeatable profit growth.
Okay, and zooming in on Q2, which, is usually a seasonally slower period for Indian hospitality. How did that look?
Look, still pretty impressive, actually. Consolidated revenue grew a solid 12% to 2,124 crores.
12% in the slower quarter. Okay.
And this is where the operational story gets really interesting, I think, for anyone tracking the sector. Normally, when a company is consolidating new assets or, rapidly scaling new areas, you'd maybe expect some margin drag.
Right, integration costs, teething problems, that sort of thing.
Exactly. But in Q2, the consolidated EBITDA margin actually expanded by 90 basis points. It hit 30.8%. So they're growing and they're doing it more efficiently.
Wow. But the real engine room, it seems, is still the standalone business, their core established luxury properties.
Oh, absolutely. The standalone Q2 EBITDA margin expanded by a remarkable 220 basis points. It reached an industry-leading 40.8%.
40.8%. Maintaining that kind of efficiency and, frankly, pricing power at the high end is, phenomenal.
It really is. And management wasn't shy about spelling out what's driving it. They pointed to three main things for the strong H1 revenue. First, a healthy consolidated RevPAR growth that's revenue per available room of 9%.
Okay, 9% RevPAR.
Second, a massive 22% growth in their new businesses vertical. So that's things like Ginger, Qmin, the ancillary services, the younger brands.
22% from new businesses. That's significant.
And third, a 21% increase in management fee income, which tells you their whole asset-light strategy is really bearing fruit, adding these highly efficient revenue streams.
Right. That management fee growth is a perfect lead-in to their expansion plan. I mean, the velocity of growth IHCL is maintaining, it's almost exhausting just trying to keep track.
It really is.
In H1 alone, they executed 46 signings and 26 openings.
26 openings. That's roughly one new hotel opening every single week.
Every week. It's incredible.
Yeah, it's staggering. And that pace has pushed their total portfolio, including the pipeline, up to 570 hotels globally. But the real game changer, I think, the story dominating this whole expansion piece, is the scale they're achieving through partnerships, primarily the Clarks deal.
Ah, yes, the Clarks acquisition. The sources confirmed that's moving quickly. 14 Clarks hotels were already onboarded onto IHCL's sales and distribution network almost straight away.
And that's just the start. The full acquisition, the entire Clarks portfolio, that's 135 hotels, right, is expected to close fully in Q3 FY26. Just think about the strategic implication there for a second.
It's huge.
This one deal is projected to instantly make their Ginger brand the, and I quote, clear leader in the mid-scale segment in India. It pushes Ginger's portfolio to over 240 hotels.
Wow. Okay, that sounds like, well, an operational challenge, doesn't it? Scaling a brand like Ginger that quickly, absorbing 135 new properties, there must be huge integration risks. Did management talk about handling that sudden jump?
They seem to view it as a necessary strategic shift for market dominance. The mid-scale segment in India is still very fragmented, but it's where a lot of the high-volume growth potential is.
Right.
So by combining their established brand strength with Clark's deep geographical footprint, they're not just adding rooms. They feel they're dramatically increasing distribution density, leveraging synergies and things like procurement technology across 240-plus hotels. This isn't just adding hotels. It feels like an attempt to really reshape the competitive landscape in the mid-market.
And alongside these massive acquisitions, they're still hammering away at the capital light growth through framework agreements.
That's right. They signed for 15 hotels with the Ambuja Neosha Group that covers Taj, Solation's Tree of Life, and another 10 Ginger hotels with the Madison Group down in South India.
And the key point there is,
The common thread in both deals is strict adherence to the capital light model. They're expanding reach, getting their brand flags out there, boosting management fee income, all without putting significant debt or huge CapEx demands on the balance sheet. They're basically monetizing their brand and operational expertise.
makes sense. On the ground, they also hit some nice operational milestones too, didn't they?
They did open their 250th operational hotel, Gateway Goa, Pololam, and showed commitment to owned assets too, opening 2 new company-owned greenfield hotels up at Ekta Nagar, a Vivanta and a Ginger.
And reinforcing the luxury core.
Yes, exactly. They finished a massive, comprehensive renovation of the chambers at the Taj Mahal Palace in Mumbai. It's this dual focus, isn't it? Scale in the mid-market, but deep investment in the luxury legacy. That seems to be the core strategy right now.
Okay, that intense focus on key owned assets like the Taj Mahal Palace renovation brings us neatly into the third segment, how they navigated Q2. Management openly called out temporary headwinds. They specifically mentioned things like heavy rainfall, landslides impacting travel.
Right, the monsoon impact.
Yeah, plus a high base effect from Q2 last year because of apparently an unusually high number of auspicious wedding dates then, and also a bit of a temporary slowdown in domestic air travel.
Correct. But this, for me, is where the beauty of strategic asset management really comes through. Instead of just hunkering down during the slower H1, IHCL used the period strategically. They deliberately chose this time to do major renovations on key, high-impact assets, like the Taj Palace in New Delhi, the President in Mumbai, Taj Fort Aguada. They pulled rooms offline.
And that strategic choice, that sacrifice, it had a real measurable impact on the numbers, didn't it? Especially on the standalone side.
Absolutely. The sources highlighted the Taj Palace renovation alone took about 150 rooms completely out of operation for 7 months during H1. That's a significant chunk of inventory and a direct hit to near-term revenue.
So they knew they'd take a hit in H1.
Exactly. It's calculated pain for what they expect to be long-term gain. They willingly absorbed that revenue dip in H1, seeing it as an investment with a massive projected payoff in H2. Management's betting that these newly renovated, refreshed properties will achieve an ADR uplift that's average daily rate of 12% to 15% in the second half of the year.
12 to 15% ADR uplift. That's huge.
It is. That kind of rate increase is designed to, well, pay back those 7 months of lost revenue pretty quickly and fundamentally reset the earning potential of those key assets for years to come.
You can really see the immediate impact of those mixed factors, the high base from last year, the renovations when you look closer at the RevPAR data. Consolidated RevPAR growth for H1 was 9%, which sounds, okay, solid. But then you look city by city.
Yeah, and you see massive variations. Take Mumbai, a powerhouse market. It achieved really high occupancy, 84%, but RevPAR growth year over year, only 2%.
Only 2%. With 84% occupancy?
That 2% perfectly illustrates the combined effect. Mumbai had the tough comparison with last year's wedding boom. Plus, it had all those Taj Palace rooms offline. That just flattened the rate growth.
Okay, makes sense.
But then, contrast that with Kolkata, also high occupancy, 83%, but it saw a whopping 17% RevPAR growth.
17%.
It shows the underlying demand is still strong across the country.
Yeah.
The soft spots in RevPAR seem directly linked to those strategic choices or just anomalous comparisons from last year.
Right. Beyond the rooms, we should also look at the success of that new businesses, Vertical, Ginger, Cumin, Amman Stays and Trails, Tree of Life. That was flagged as a core growth driver.
Definitely. Consolidated revenue for this whole vertical grew 22%.
22% again. Consistent theme.
In Ginger, the brand that's about to become this mid-scale leader, it reported a really impressive EBITDA margin of 41%.
41% margin for Ginger. That's very strong for the mid-segment.
It's powerhouse profitability, yeah. Few competitors can touch that. And elsewhere in that vertical, Qmin, their food delivery service, expanded to 104 outlets. The AMA Stays and Trails portfolio hit 331 bungalows, with another 174 in the pipeline.
So these other businesses, they're not just side projects.
Not at all. They seem to be high flow-through businesses providing important diversification and pretty robust incremental margins.
And that robust performance flows right through to the balance sheet strength, which brings us to our final segment, investment and the outlook. IHCL seems to maintain a remarkably healthy balance sheet. End of September 2025, they had a gross cash balance of 2,847 crores.
Almost 3,000 crores in cash. And that's after they spent around 480 crores on CapEx, just in the first half.
Wow. What's the plan for the full year capex?
They're guiding for a total spend between 1,000 to 1,200 crores for FY26. And importantly, they expect to fund every single rupee of that massive investment entirely from internal accruals.
No external funding needed for that scale of investment.
Apparently not. They're just a cash-generating machine right now.
And that focused investment, that efficiency, it shows up in the return ratios, doesn't it? They highlighted improvements there.
Yeah, demonstrating better capital efficiency. Return on capital employed, ROSE, rose to 17.3%. That's up 1.6 percentage points. And return on equity, ROE, hit 15.5%.
Hitting 17.3% ROCE.
That's pretty critical, isn't it? It suggests that every rupee they invest is generating significantly more return than many competitors. Sort of cements their benchmark status.
It does, and they're using that cash very strategically, building high-yield, owned assets that should ensure long-term competitive advantage. We're not just talking management contracts here. This is about building brand legacy assets.
Okay, tell us about some of those key owned assets they're pushing forward. What's in the pipeline?
Well, they're kicking off construction on the Taj Bandstand in Mumbai. That's a major, high-profile, future-focused project. But they're also focusing on high-yield brownfield expansions in markets with proven high demand. So, for example, they're expanding the Taj Ganges in Varanasi by 100 keys. That's expected by Q4 FY26. And a similar 100-key expansion at the Taj Lucknow by 2027. So adding capacity in markets they know perform well.
Exactly. These are critical additions in places that consistently run high occupancy and command strong average rates.
And what about the really high-profile greenfield projects, the ones pushing into unique destinations?
Right, the luxury push, absolutely. The Taj at Lakshadweep is a big one, planned for around 180 keys. And also the new Ginger near Goa's MOPA airport. That'll add about 275 keys to that vital gateway market.
And internationally.
They're actively reinforcing that presence, too. The Taj Frankfurt is expected to finally open its doors in Q4 FY26.
Okay, so looking ahead, it feels like all the pieces are lining up for a pretty strong second half of the year. What are the major tailwinds they're banking on?
Well, the structural tailwinds look huge. Industry demand is forecast to grow by around 10%, but supply growth is really struggling to keep up. Projections are only between, say, 4.6% to 7.7% CKG across major cities.
So a classic demand-supply gap.
Precisely. And IHCL seems perfectly positioned to capitalize on that. On top of that, the second half of this fiscal year has, just structurally, a higher number of auspicious wedding dates compared to last year. That should drive rate growth.
Ah, the wedding factor again.
Yeah. Plus, major MICE events, meetings, incentives, conferences, exhibitions, and global sports, including the T20 World Cup, apparently, and some global summits. So lots of demand drivers lining up.
And finally, we should probably just briefly touch on Pathia, their ESG framework. It seems to be a big focus for the company.
It is, yeah, ESG +1.
Yeah.
And they are making progress towards some pretty ambitious 2030 goals. They reported using 41% renewable energy currently and recycling 51% of the water used across their properties.
That commitment, it's not just ethical, is it? It has operational benefits, too.
Oh, absolutely. Long-term operational cost management, brand value, it's all intertwined now. And their goal to skill over 100,000 young people by 2030, I mentioned they've already empowered over 35,000 since 2020. So real progress there, too.
Okay, so if we try to synthesize everything from this deep dive, the central takeaway for you, the listener, seems to be this execution of a highly successful kind of dual mandate strategy. On one side, they're maximizing yield and profitability from their high-end, renovated-owned assets, that aggressive ADR uplift strategy we talked about.
Right, getting more from the core.
And simultaneously, they're just aggressively scaling their capital-light, high-margin, mid-scale portfolio, mainly through massive deals like Clark's.
Yeah, combining those two approaches seems to be the key. And that combination gives management the confidence to really stick firmly to their outlook. They're anticipating planning for double-digit revenue growth for the full fiscal year, driven by those strategic tailwinds, the renewed quality from renovations, and just the sheer expanded scale of their entire portfolio heading into H2.
Which leaves us with this provocative thought for you to mull over. Given IHCL's very clear ambition now to become the dominant mid-scale leader in India, largely through the Clark's deal, and considering their really strong cash reserves and self-funding capability, how might this increasing focus on domestic dominance impact their strategic thinking around international acquisitions?
That's interesting.
Now that high-profile owned assets like the Taj Frankfurt are finally coming online after years of work, is the next major wave of expansion likely to be another big international acquisition, maybe leveraging that stronger domestic base? And if so, where might that next major international footprint likely emerge?
The cash is certainly there, as we discussed. It really comes down to where they see the highest long-term competitive return, doesn't it? Domestic scale versus international prestige and diversification. Definitely something to think about as the market keeps evolving.
Indeed. We'll leave it there for this deep dive. We'll catch you next time.